Okay, so imagine you wake up tomorrow morning and something extraordinary has happened. You arrive at work just like every other day. You grab a coffee, open your laptop, answer a few emails, join your first meeting. Nothing seems different until your manager announces something that changes everything. From today onward, every employee owns part of the company, not just the CEO, not just the founders, not just wealthy investors. Everyone, the receptionist, the software engineer, the warehouse worker, the delivery driver, the accountant, the customer support representative. Every person helping the business succeed now owns a share of that success. Every new customer increases the value of something you own. Every profitable quarter makes your investment more valuable. Every innovation creates wealth that belongs partly to you. Suddenly, your job is no longer just a paycheck. It's an investment. Now imagine that this didn't happen at just one company. Imagine it happened at every company, every restaurant, every supermarket, every factory, every bank, every airline, every hospital. Every technology company, every construction business, every retail store, every logistics company, every employee, everywhere became an owner. Would people work harder? Would businesses become more successful? Would billionaires disappear? Would wealth become more evenly distributed? Or would the entire global economy collapse under the weight of a system that sounds fair in theory but impossible in practice? It sounds like a simple question. But hidden inside that question is one of the biggest economic debates of the last century, because almost every company on Earth is built around one fundamental idea: ownership. When most people think about a business, they imagine the products, the customers, the employees, the offices, the factories, the advertisements, the profits. But none of those things answer one simple question: who actually owns the company? That single question quietly determines where billions of dollars flow every single year. Take a look at the company you work for. Whether it's a small local business or one of the largest corporations in the world, someone owns it. Sometimes it's one founder, sometimes it's a family, sometimes it's millions of shareholders spread across the globe. But in almost every case, the majority of employees spend decades helping build a business they will never actually own. They create products, solve problems, serve customers, increase profits, help the company grow. Yet, when the company becomes worth $10 billion or $100 billion, most workers receive the same thing they always have: their salary. Meanwhile, the owners watch the value of their shares continue climbing year after year. That's why ownership has become one of the greatest creators of wealth in modern history. Think about companies like Apple, Microsoft, Amazon, Google, Meta, Nvidia. Millions of people helped build those businesses. Engineers wrote the software. Designers created the products. Sales teams found customers. Warehouse workers shipped millions of orders. Managers coordinated thousands of employees. Entire generations devoted their careers to helping those companies grow, but the overwhelming majority of the wealth created by those businesses flowed toward one group: the owners. That's how capitalism has worked for centuries. Capital earns returns. Labor earns wages. One side owns the machine. The other side helps operate it. For most of history, people accepted this as the natural order of business. If you wanted ownership, you started a company. If you couldn't start one, you worked for someone who already had. Simple? At least, that's how it appeared. But over the past several decades, something interesting started happening. Economists began asking an uncomfortable question. What if employees weren't just workers? What if they were owners too? Not through charity, not through government programs, not through wealth redistribution, but through the companies they helped build every single day. Suddenly, businesses around the world began experimenting with a completely different model. Instead of paying employees only with salaries, they started giving them shares, ownership.equity, a direct financial stake in the company's future. At first, many people dismissed the idea. Why would a founder voluntarily give away part of their company? Why would investors accept smaller ownership? Would employees even care? But something surprising happened. In many cases, companies with employee ownership didn't become weaker. They became stronger. Employees stayed longer. Productivity increased. Innovation accelerated. People began thinking like owners instead of workers, because for the first time, success wasn't something they watched from the sidelines. It was something they personally benefited from. Silicon Valley quietly embraced this idea decades ago. Many early employees joined tiny startups for relatively modest salaries. Instead of demanding higher pay, they accepted stock options, pieces of ownership that looked almost worthless at the time. Most of those startups failed. Those shares became worthless. But a handful of companies succeeded beyond anyone's imagination. Google, Microsoft, Nvidia, Meta. Countless early employees became millionaires. Some became billionaires. Not because they earned extraordinary salaries, but because they owned part of what they were helping create. That raises a fascinating question. If ownership creates so much wealth, Why don't more companies share it? Why do millions of workers spend their entire careers building businesses they'll never own? Is the current system truly the most efficient? Or has the world simply become accustomed to a model that benefits owners far more than the people creating the value every day? Because here's something most people never realize. Employee ownership isn't some futuristic economic experiment. It already exists. Across the world, thousands of companies are partially or entirely owned by their employees. Some compete against the biggest corporations on Earth. Some generate billions of dollars in annual revenue. Some have been operating successfully for decades, which means the real question isn't whether employee ownership works. The real question is why it remains the exception instead of the rule. To answer that, we first need to understand how ownership actually works inside modern businesses. Because once you follow the money, you'll discover that ownership is far more powerful than almost anyone realizes. And that's where the real story begins. So how would employee ownership actually work? Most people imagine one simple solution. Give every employee a few company shares. Problem solved. But ownership is far more complicated than that, because businesses aren't simply collections of employees. They're collections of capital. Every company begins with someone taking enormous financial risks. A founder spends years developing an idea, invests personal savings, borrows money, works countless unpaid hours, faces the possibility of complete failure long before the first employee is ever hired. That founder already owns something valuable, not because the company is profitable, but because they accepted the risk nobody else was willing to take. That's the foundation of modern capitalism. Risk creates ownership. Ownership creates wealth. As the business grows, new people enter the picture. Investors provide funding. Banks provide loans. Employees provide skills. Suppliers provide products. Customers provide revenue. Every group contributes something different, but not every contribution receives the same reward. Employees receive salaries. Banks receive interest. Suppliers receive payments. Investors receive ownership. And ownership is where the biggest fortunes are created. Because salaries eventually stop. Ownership continues growing. Imagine two software engineers graduating from the same university. Both earn similar salaries. Both work equally hard. Both are equally talented. The first joins a traditional company that pays a higher salary. The second joins a startup offering a lower salary but meaningful ownership through stock options. For several years, the first engineer appears to be making the better decision. Their paycheck is larger. Their lifestyle improves faster. The startup employee sacrifices higher income for shares that might never become valuable. Then something extraordinary happens. The startup launches a revolutionary product. Millions of customers begin using it. Revenue explodes. Investors compete to buy ownership. Eventually, the company goes public. Almost overnight, those once worthless shares become worth millions of dollars. The engineer didn't become wealthy because of salary. They became wealthy because they owned a small piece of something that became incredibly valuable. That's exactly how thousands of employees at companies like Google, Apple, Nvidia, Microsoft, and Meta built life-changing wealth, not by earning the highest wages, but by participating in ownership. This is where employee ownership begins changing the economics of work. Instead of viewing employees as labor, the company begins viewing them as long-term partners. Every improvement they create increases the value of something they personally own. Every customer they attract strengthens their own investment. Every innovation becomes a shared victory. Suddenly, motivation changes. Employees no longer ask, "How much will I earn this month?" They begin asking, "How much value can we create over the next 10 years?" That shift completely changes how businesses operate. Studies repeatedly show that employee-owned businesses often experience lower staff turnover, higher engagement, greater productivity, and stronger long-term commitment. Because people naturally care more about protecting something they own. Think about renting a house. Now compare that to owning one. Homeowners usually invest more in maintenance, improvements, long-term planning, because every improvement increases the value of their own asset. Employee ownership creates the same psychological effect inside a business. People stop thinking like temporary workers. They begin thinking like business owners. Some companies have built entire business models around this idea. One of the world's largest employee-owned companies is the John Lewis Partnership in the United Kingdom. Every permanent employee is known as a partner. Instead of outside shareholders collecting all the profits, a significant portion is shared with the people working inside the business. In Spain, the Mondragon Corporation operates as one of the largest worker cooperatives in the world, employing tens of thousands of people across manufacturing, finance, retail, and education. In the United States, companies such as Public Supermarkets and Winco Foods have helped thousands of employees build wealth through ownership programs. These aren't small experiments. They're multi-billion-dollar businesses competing successfully in highly competitive industries. So why doesn't every company adopt this model? Because ownership comes with difficult trade-offs. Imagine you're a founder building a startup. You've spent 5 years creating your business, mortgaged your house, borrowed money from friends, worked weekends without pay. Finally, investors offer $100 million to expand your company, but they want ownership. If you've already given large portions of the business to employees, your own ownership becomes smaller. Future investors receive less. Fundraising becomes more complicated. Decision-making can also become slower. If thousands of employees own significant voting rights, reaching agreement on major business decisions becomes far more difficult. Should the company expand internationally, acquire another business, invest billions in artificial intelligence, close an unprofitable factory, lay off employees during a recession? Traditional corporations usually make those decisions quickly through executives and shareholders. Employee-owned companies often require broader participation. That can improve fairness, but it can also reduce speed. There's another challenge few people consider: risk concentration. Imagine your salary already depends on your employer. Now imagine your life savings also depend on the same company. If the business fails, you don't just lose your job, you lose your investment as well. That's exactly what happened to many employees during famous corporate collapses. Thousands of workers watched both their careers and retirement savings disappear at the same time. That's why financial experts often recommend diversification instead of placing all your wealth into one employer. So employee ownership isn't a perfect solution. Neither is traditional capitalism. Both systems solve certain problems while creating new ones. The real question becomes much larger. Can companies create wealth for employees without sacrificing innovation, investment, and long-term growth? Because if they can, the implications are enormous. Millions of ordinary workers could gradually become investors instead of spending their entire careers earning wages alone. Wealth inequality could begin changing from inside the private sector rather than through government policy. Entire communities could become financially stronger as successful companies create thousands of employee shareholders instead of only a handful of billionaire founders. It sounds almost revolutionary, yet in many places, it's already happening. The question is no longer whether employee ownership is possible. The question is whether it could ever become the dominant model for the global economy. Because if that day ever arrives, it wouldn't just change how companies operate. It would change who benefits when businesses succeed, and that could completely redefine the future of capitalism. So what would actually happen if every company became employee-owned? Would capitalism become fairer, or would it simply create a different set of problems? The answer isn't as simple as most people think. Because the goal of every business has never been to create jobs. Its goal is to create value. The more value a company creates, the more wealth it generates. The real question is who receives that wealth. Today, the answer is relatively clear. Founders, investors, shareholders. Employees benefit through salaries. Owners benefit through appreciation. But imagine a world where those two groups slowly become one. A world where millions of workers aren't simply helping someone else build wealth. They're building wealth for themselves. Every successful product launch increases their own net worth. Every new customer strengthens their own investment. Every profitable year rewards everyone contributing to the business, instead of only those who financed it. That sounds incredibly attractive. But it also changes how companies make decisions. Imagine every employee voting on major business strategies. Should the company automate factories? Should it replace workers with artificial intelligence? Should it close an underperforming office? Should it expand into another country? Those decisions affect people's jobs, their investments, and their future. Balancing profitability with employee interests becomes much more complicated. That's why many economists believe the future won't be entirely shareholder-owned or entirely employee-owned. Instead, it may become a hybrid. Founders continue creating companies, investors continue providing capital, but employees gradually receive larger ownership stakes as businesses grow. In many ways, that's already happening. Technology companies increasingly use stock options. Employee stock ownership plans continue expanding. More startups offer equity instead of simply increasing salaries. Companies are slowly realizing something important. The people building the business are often its greatest competitive advantage. Keeping them motivated creates long-term value. There's another reason this trend may continue. Younger generations increasingly care about ownership. Many realize that salaries alone rarely create lasting wealth. Inflation reduces purchasing power. Living costs continue rising. Housing becomes more expensive, but ownership has historically remained one of the most reliable paths toward financial independence. That's why millions of people invest in stocks, buy real estate, launch businesses, or search for opportunities that allow them to own assets instead of simply earning wages. Employee ownership combines those two worlds, a career and an investment. But perhaps the biggest lesson isn't about employee ownership at all. It's about understanding how wealth is actually created. Most fortunes weren't built by earning the highest salaries. They were built by owning valuable assets that increased in value over time. That's true, whether it's company shares, real estate, businesses, or intellectual property, ownership quietly compounds wealth, while salaries usually stop growing the moment you stop working. So what if employees owned every company? The world probably wouldn't become perfectly equal. Some businesses would still succeed, others would still fail. Innovation would still create winners and losers. Risk would still exist, but millions of ordinary. Workers might finally participate in the wealth they spend their lives creating. Perhaps that's the future capitalism is gradually moving toward, not replacing entrepreneurs, not eliminating investors, but expanding ownership to the people helping build successful businesses every single day. Because maybe the greatest economic question isn't who works the hardest or who invests the most money, it's who gets to own the future. And if history has taught us anything, it's this: the people who own the assets usually shape the economy, but the people who build those assets shape the future. Perhaps one day they'll be the same people. And if that happens, it won't just change businesses, it could change capitalism itself.